One of the Philippines' biggest universal banks, BPI, is coming off a fourth straight record year, but with profit growth normalizing and rate cuts changing the landscape. BPI is also issuing and listing with the Philippine Dealing and Exchange Corporation tomorrow, Friday, its 2-year, 5 billion peso denominated fixed-rate BPI Sigla bonds. Well, with us now for more is TG Limcaoco, President and CEO of BPI. It's good seeing you, TG. Welcome back to the program.
Morning, Kathy. Good morning.
All right, so first, your earnings outlook for the year. Your press release here mentions the phrase sustaining positive jaw. Positive jaw in bank speak means gross income growth exceeding expense growth. But for how much longer, DG, can you do so? Generate revenue efficiently without increasing expenses, given slowing economic conditions?
I think, Kathy, that's something that we aim to do year in, year out. We have gotten our expenses to be something more reasonable. In the last couple of years, we've been investing a lot in technology. 4 years ago, our technology spend grew 25%. Last year, our technology spend only grew 12.8%. So our technology is on track. We've got the right stack, and that will really allow us to keep our expense growth lower than our revenue growth. Revenue growth last year was 14.8%, and expense growth was 9.9%. Our budget this year is for expense growth to be about 10%.
All right, but we're clear that earnings growth is clearly going to be slower than the past few years. So how would you describe where BPI is in this cycle? Do you think it's normalizing or entering a tougher phase for bank profitability?
I think we're coming to a more normal phase. In last year, our net income grew 7.4%. That actually is quite a decent performance for us, given the events of the second half of the year where things significantly slowed down. I think what's going to happen this year is that we're entering the year quite cautious, but I feel that the sentiment can turn very quickly, and if it does, then business can pick up very quickly. I think the sort of malaise we have really today in the economy is about uncertainty and lack of confidence, but I think that's something that can turn very quickly because there's nothing structural wrong with our economy.
That's good to know, but what sort of metrics, though? What sort of factors do you need to see to say that the sentiment has shifted and pivoted?
Well, I take a look at the top corporates beginning to build up, their working capital again and begin to start drawing on their lines for their investments. The consumer remains fairly resilient. We're seeing billings and spending continue to grow. We are seeing a little bit weaker, probably in mortgage, given that during the pandemic, a lot of the real estate companies stopped projects, and we're going to feel that this year. But other than that, we'd look to the consumer to follow where the corporates are going and where job creation and the GDP growth actually turns more upbeat than the 4% we saw last year.
All right, so consumers going to be the driver, but you've got other levers here. You've got SME, the corporates, or the fee-based and the digital ecosystems. So given, say, 1 or 2 years, where do you see growth coming from the biggest?
We'll continue to grow our consumer book quite significantly. And Kathy, for BPI, when we talk consumer book, that includes SME. So we consider what we call our institutional book, which are top corporates and multinationals. And then everything is the non-institutionals, which is SMEs all the way down to personal loans and, credit card billings.
But how comfortable are you with the risk you're taking there with the consumers? And where do you think you're being most conservative today, given that the turn hasn't come and there's still a lot of uncertainty?
I guess, Kathy, people have to understand that what BPI is trying to do now is be a more inclusive bank, and therefore we're opening our facilities to a broader market, a market that typically we had not served maybe 10 years ago. And there's nothing wrong with higher credit costs for as long as you're pricing it correctly. And the reason you're able to price it correctly is because we have the data and we have the products that cater to these segments. And so if you have a non-performing loan of, let's say, on the credit card business, which is about, in our books, about 4.5%, as long as you're pricing it correctly, we can extend our credit card, let's say, availability to more and more segments of society.
Well, let's get into those NIMs, the net interest margins, as you made a mention of pricing those loans. It's been strong at 4.6% as of September last year. Will you still be able to keep that intact, do you think, with the Bangko Sentral easing policy further? And which segment
I
or
think,
segments are
yeah.
showing the earliest signs of stress, if any?
Yeah, typically, theoretically, as the Bangko Sentral lowers policy rates, interest rates will fall on the asset side. But I think people have to remember that in the immediate term, what falls first is the liability side as time deposits fall quickly. And time deposits in the Philippine context have an average life of 30 days. So that falls very quickly. Whereas our corporate loans typically have a repricing of maybe 6 months. And then consumer loans are much slower because auto loans are fixed for the next 5 years. Mortgages are fixed for 1 year or 5 years. So the asset side falls much slower. The bank also is focused on expanding our loan base to be more focused on what we call the consumer non-traditional, which is a higher yield. So we're looking at over the long term, maybe a 25 basis point cut will reduce our NIM by about 4 basis points. But in the immediate term, we hope to sustain it by expanding our loan book to be more consumer oriented and by being very disciplined in our pricing for corporate loans and for time deposits.
Let me pick up on discipline. Are you tightening standards in products like, say, auto, credit cards, or even the unsecured lending before the stress shows up in the numbers?
Yes, we do tighten up as we see NPLs rise and as we see the inability to raise interest rates because of competition. So naturally, you'll have to make that trade-off between who you lend to, the risk that we're undertaking by lending to this segment, and of course, the rate we're able to charge them. So it really is dependent on competition. If competition is very tight, then there are some segments we will back away and let our competition take them. There are other products that we are just entering now and are able to tap into our network and our distribution channels to tap a larger market. For example, teachers' loans. We've grown that significantly over the last 2 years.
Could you give us more color there? That's pretty interesting. A very niche sort of offering you have. How's that contributing to profits?
You know, Kathy, our public school teachers are one of the most devoted workers in society. And together with the Department of Education, there is a program where we are able to lend to teachers, and it's paid out of their salaries. That is a business that was with Robinsons Bank. But as we merged with Robinsons Bank, what we have been able to do for teachers' loans is grow it fourfold over the last 2 years because we have a much wider distribution network today. We're able to use all 800 branches of BPI to access and inform the teachers and give them access to this product. So it's been a win-win for both sides, both for the teachers and for BPI.
But even if you've got maybe one more cut versus a longer pause, I mean, how sensitive is loan demand going to be, especially for, say, new products like teachers' loans, if we get one more cut?
The demand, I think if you have a cut and we're able to reflect that in the rate, and teacher loans are actually quite reasonably priced and affordable, you'll see more demand.
What about the easing and at least one more cut expected? How much of a margin pressure are you bracing for still? And what sort of levers do you have to defend your net interest margins?
So 2 ways, as I said. One is we will, obviously, the first impact will be lower time deposits or lower funding costs. That should allow us to expand the NIMs in the short run, very short run. But over the long run, theoretically, if your loan book doesn't, if the shape of our loan book doesn't change, then we lose about 4 basis points in the long run. But we will try to turn more and more towards consumer loans, which have a higher yield, and try to negate the effect of a cut. So we're hopeful we can keep NIMs.
What about the credit margins? Very interesting this year with the potential increase in the interest rate differential between the Bangko Sentral and the Fed.
Mm-hmm. Well, if the BSP delivers a cut next week as expected, 25 basis points cut, you'll see the smallest differential between U.S. policy rates and Philippine policy rates ever. It will be down to 50 basis points. Even today's differential of 75 is a record low. And there's confidence that our currency can hold with this 50 basis points cut. And I believe the BSP is looking at cutting. I think most analysts are looking at the cut really to spur economic growth there's some concern about inflation, but with inflation today where it is, I think there's room for that.
Do you think there's still room? I mean, he just said about 24 hours ago that he'd be concerned if inflation tracks above their projection of 3%.
Yes, so that was a surprise from Governor Ellie, given that their target is 2 to 4%. But the mandate of the Banco Central is price stability. So they have every right to focus on price stability over economic growth. Our forecast is 25 basis points cut next week and another 25 sometime down the year. So 50 for the full year.
Well, as a banker, what do you make of the communication that he's put out there over the last couple of months? Pretty mixed signals, haven't they been?
No, I think he's giving more direction, more clarity on what he believes the mission of the BSP is. And actually, from my perspective, I like the way they communicate. I like the way they are talking about their thinking. And for me, the clarity on their focus on the BSP's mission is good.
Final point, DG, I know that you've got your Sigla bonds. You've got a public offering of a 2-year, 5 billion peso denominated fixed rate BPI Sigla bonds. It's quite a mouthful, but what response are you expecting when they're issued and listed in the PDEX tomorrow, Friday?
Yeah, the Sigla bonds are 2-year bonds that we're issuing. We had a lot of demand, and we're issuing a total of 50 billion. We had planned, obviously, planned to issue 5, but the demand was so great. We're issuing 50 billion, and that's listing tomorrow. So thanks to everyone who participated. It's part of our strategy to diversify our funding. And the 50 billion that we're raising is really to be used for social bonds, ASEAN social bonds, which really are being lent to businesses to help the social enterprises.
So investors should expect more frequent social or sustainability-linked bonds from BPI?
I think we are using bonds now as a strategy to diversify our funding. So yes, people should expect that over time we will be issuing more bonds. Not necessarily social bonds. Some might be green, some might be blue, and some might be plain vanilla.
All right. Well, thank you so much for the insights there. DG Limcaoco, the President and CEO of BPI.